There's a question I get asked in different forms over and over, especially when markets feel uncertain or when people are worried about the economy. What should I do with my money right now? Should I sell everything? Should I buy gold? Should I move to cash? Should I try to time the market? They're looking for some specific action, some move they can make today that will protect them from whatever storm they think is coming. And my answer is almost always the same, though it's not the answer most people want to hear. The most important thing you can do right now, today, this moment, is probably nothing. Or, more precisely, the most important thing is to make sure you're not going to do something stupid when you get scared or greedy, because that's what destroys wealth. Not market crashes, not recessions, not inflation, but panic-driven decisions and greed-driven decisions that cause you to buy high and sell low, to abandon your strategy at exactly the wrong time, to chase performance or flee from volatility in ways that lock in losses and miss recoveries. Let me start with a story. Back in 2008, during the financial crisis, I knew a man who had about $800,000 in his retirement account. He was in his late 50s, had been saving diligently for decades, had a reasonable mix of stocks and bonds. Then the market started falling. Every day, he'd check his account, and every day it was worth less. By October of that year, he was down to about $500,000. He couldn't sleep. He couldn't focus at work. He was convinced the entire financial system was going to collapse and his money would vanish. So he sold everything, moved it all to cash. He felt immediate relief. The bleeding stopped. His account wasn't going down anymore. He protected himself, or so he thought. Then the market started recovering in March of 2009. By the time he noticed and got back in, much of the recovery had already happened. He'd missed it. When he finally retired a few years later, his account was worth maybe $650,000. If he just held on, stayed invested through the crisis, his account would have been worth well over $1 million, possibly closer to $1.5 million, depending on his exact allocation. That decision to sell at the bottom, driven by fear and the feeling that he had to do something, cost him hundreds of thousands of dollars and fundamentally changed his retirement. And here's the thing, his instinct to protect his money wasn't wrong. His execution was disastrous. So when I talk about protecting your money, I'm not talking about moving it around, getting defensive, trying to outsmart the market. I'm talking about protecting it from your own worst impulses. That's the real threat. That's what you need to guard against right now and every day. Now, before I go further, let me be clear about a few things. This is general education, not personal advice for your specific situation. Everyone's circumstances are different. Your age, your income needs, your risk tolerance, your time horizon, all of these factors matter enormously, and you should work with a qualified financial advisor to figure out what's appropriate for you. Nothing I say here is a recommendation to buy or sell anything. I'm just sharing principles that have served me well over many decades. The first principle is this. If you're invested appropriately for your situation, doing nothing is usually the right move. The market goes up and down, that's normal. That's the price you pay for the opportunity to earn returns over time. If you've got decades before you need the money, short-term volatility shouldn't concern you. If you're close to retirement or already retired, you should have enough in stable assets that you don't need to sell stocks when they're down. Either way, reacting to market movements typically makes things worse, not better. I've been investing for over 70 years. I've lived through more bear markets, more crashes, more crises than most people alive today. And the single biggest predictor of success I've seen is not intelligence, not education, not access to information. It's temperament. It's the ability to stay calm when everyone else is panicking, to stick to your plan when it feels like the world is ending, to resist the urge to act just because you feel like you should be doing something. That doesn't come naturally to most people. We're wired to respond to threats. When we see danger, we want to run. When we see our account balance dropping, we want to stop the pain. But in investing, that instinct often leads you to do exactly the wrong thing at exactly the wrong time. So how do you protect yourself from yourself? How do you build the kind of temperament that allows you to weather storms without making destructive decisions? I think it starts with understanding what you own and why you own it. If you've got a portfolio and you don't really know what's in it, if you can't articulate why you own stocks versus bonds versus whatever else, if you're just following someone's advice without understanding the logic, you're going to panic when things get rough. You won't have conviction. You won't have a framework for deciding whether to stay the course or adjust. But if you understand that stocks represent ownership in real businesses, businesses that produce goods and services people need, businesses that generate earnings and pay dividends, then you can weather temporary price declines without losing your mind. You know that the underlying value hasn't disappeared just because the market price dropped. You know that good businesses adapt and survive and thrive over long periods, even if they struggle in the short term. Let me give you an example from my own experience. During the 1970s, the stock market went basically nowhere for a decade. Inflation was high, interest rates were high, there was an energy crisis, there were recessions. It was a miserable time to be an investor if you were judging by short-term results. A lot of people gave up on stocks, moved to real estate or gold or whatever else seemed safer or more promising, but I kept buying stocks. Not because I knew the market was going to turn around, but because I could find businesses trading for less than they were worth. Good businesses with strong economics, competent management, and reasonable prices. I didn't know when the market would recover, but I knew that over time, the value of those businesses would be recognized and I'd do well. And that's what happened. The 1980s and 90s were fantastic for stocks. And the people who stuck with it through the 70s were rewarded. The people who bailed out missed the entire recovery. Now, I'm not saying you should just ignore your portfolio and hope for the best. I'm saying you should set up a sensible strategy that you can stick with through good times and bad, and then you should stick with it. That strategy should be based on your situation, not on market forecasts or economic predictions or what some talking head on television says is going to happen next. For most people, that probably means a diversified portfolio of low-cost index funds, tilted toward stocks if you're young and toward bonds if you're older, rebalanced periodically to maintain your target allocation. Nothing fancy, nothing complicated, just a simple, boring approach that works over time because it keeps you invested and keeps you from making emotional decisions. The second principle is to never invest money you might need in the next few years. This is absolutely critical. If you're going to need money for a down payment on a house, or to pay for your kids' college, or to cover living expenses and early retirement, that money should not be in stocks. It should be in cash or very short-term bonds where you know it'll be there when you need it. The risk isn't worth it. I've seen people violate this rule over and over, and it almost always ends badly. They put money they need in 18 months into stocks because they want to earn a better return. Then the market drops 20% and suddenly they've got a problem. Either they sell at a loss and lock in the damage, or they scramble to find another source of funds, or they delay their plans. None of those outcomes are good. The way to protect your money is to match your assets to your time horizon. Long-term money can handle volatility. Short-term money cannot. If you get that right, you're not forced to make decisions based on what the market is doing. You can wait out the bad times because you don't need the money today. I'll tell you about a couple I knew who got this exactly right. They were in their early 60s, planning to retire in a few years. They had about $1 million saved. They sat down with an advisor and figured out how much they need to cover expenses for the first 5 years of retirement. That amount, about $200,000, they moved into a ladder of CDs and short-term bonds. Money they knew would be there, no matter what happened in the stock market. The rest stayed invested in a mix of stocks and bonds appropriate for their age. When the market dropped in early 2020 during the pandemic panic, they didn't care. They had 5 years of expenses locked in. They could wait for the market to recover before they needed to sell anything. And of course, the market did recover fairly quickly. And they were fine. They weren't forced into panic selling. They had protected their money by setting up a structure that removed the pressure to react. The third principle, and this one is really important, is to avoid debt, especially high interest debt. If you're carrying credit card balances or personal loans at 10 or 15 or 20% interest, your first priority should be paying those off, not investing. You cannot reliably earn returns that will beat those interest rates, especially after taxes. Paying off high interest debt is a guaranteed return, and it's one of the best investments you can make. I've never understood people who carry credit card debt while simultaneously trying to build an investment portfolio. You're paying 15% on one side and hoping to earn 8 or 10% on the other side. The math doesn't work. Pay off the debt first, then invest. The only exception might be a mortgage at a very low rate, where you could reasonably expect to earn more investing than you're paying in interest. But even then, there's something to be said for the peace of mind that comes with owning your home outright. Debt makes you fragile. It reduces your options. It forces you to keep earning money to service the debt, which means you can't take risks in your career or retire early or weather a job loss without stress. The less debt you have, the more resilient you are, the better you can handle whatever life throws at you. That's protection, that's security. Not trying to earn an extra % or 2 in the market, but reducing your obligations so you have room to breathe. The fourth principle is to understand that protection doesn't mean avoiding all risk. Some people hear about market volatility and they think the safest thing is to put all their money in a savings account or under a mattress. That might feel safe, but it's actually quite risky in a different way. You're taking the certainty of losing purchasing power to inflation in exchange for avoiding the uncertainty of market fluctuations. Over long periods, inflation will eat you alive if you're sitting in cash. Let's say you've got $100,000 and you leave it in a savings account earning 2% while inflation runs at 3%. You're losing 1% of purchasing power every year. Over 20 years, your real wealth has been cut by about 18%. You still have $100,000, but it only buys what $82,000 bought when you started. That's not protection. That's slow motion wealth destruction. So you've got to balance the risk of market volatility against the risk of inflation. For most people, especially younger people, the inflation risk is bigger. You need to be invested in assets that can grow faster than inflation. Stocks historically have done that. Real estate can do that. But you've got to accept short-term volatility as the price of long-term growth. Now, if you're older and you're living off your savings, the calculation changes. You can't afford to have your portfolio drop 30% right when you need to take distributions. So you need more stability, more bonds, maybe some cash for near-term expenses. But even then, you probably need some growth assets or you'll run out of money in a long retirement. It's all about balance and matching your portfolio to your situation. Let me talk about something else that I think is important for protecting your money. Simplicity. The more complicated your financial life, the more ways things can go wrong. I see people with money scattered across a dozen different accounts, invested in all kinds of exotic products they don't really understand, trying to optimize every little detail, and usually they'd be better off with a simple portfolio of index funds in 1 or 2 accounts. Complexity creates costs, more fees, more taxes, more time spent managing things, more opportunities to make mistakes. Simplicity reduces all of that. It makes it easier to see what you have, easier to make decisions, easier to stay disciplined. And in investing, staying disciplined is more important than being clever. I built a fairly complicated business over the years with Berkshire, but my personal advice to almost everyone is to keep it simple. Own a piece of American business through a low-cost stock index fund. Own some bonds for stability. Rebalance once a year. Don't try to be fancy. Don't try to beat the market. Just participate in it steadily over time and let compounding do the work. The people who try to get fancy, who chase the latest trend or listen to some guru promising guaranteed returns or try to time the market, those are the people who usually end up disappointed. Not all of them, but most of them, because beating the market consistently is incredibly hard. Even professional investors with teams of analysts and enormous resources struggle to do it. What chance does the average person have? You're better off accepting market returns, keeping your costs low, and focusing your energy on the things you can control. How much you save, how long you stay invested, what you spend money on. Those decisions have a much bigger impact on your financial success than trying to pick the right stocks or time the market perfectly. Now, let me address something that comes up a lot. People ask me about diversification. How much is enough? Can you be too diversified? These are good questions. Diversification is important because it reduces your risk. If you own one stock and that company goes bankrupt, you lose everything. If you own 100 stocks and one goes bankrupt, it barely matters. But there's a point of diminishing returns. Owning 500 stocks isn't meaningfully more diversified than owning 100 stocks. You're not reducing your risk much, and you might be diluting your returns by forcing yourself to own mediocre businesses alongside good ones. For most people, a total market index fund gives you all the diversification you need. You own thousands of companies across different sectors and sizes, and you don't have to think about it. Some people worry about international diversification. Should you own foreign stocks? It's not a bad idea to have some exposure to markets outside the United States, but I wouldn't obsess over it. The U.S. market has been incredibly successful over time, and many American companies earn significant revenue overseas anyway. If you want to add some international exposure, fine, but don't feel like you need to make it a huge portion of your portfolio. The key is to own enough different things that no single event can wipe you out, but not so many things that you don't know what you own or why you own it. A handful of low-cost index funds covering stocks and bonds, domestic and maybe international, is plenty for most people. You don't need dozens of individual holdings or exotic investments. Let me come back to where I started. The most important thing you can do to protect your money right now is to make sure you're set up in a way that allows you to do nothing when the market gets scary. That means having a portfolio appropriate for your situation, having enough cash or short-term bonds to cover near-term needs, avoiding debt that creates pressure, and understanding what you own well enough that you don't panic when prices drop. It also means making peace with uncertainty. You're never going to know what the market's going to do next month or next year. Nobody does. The people who claim to know are either lying or deluded. The market is going to do what it's going to do, and your job is to position yourself so that you can handle whatever happens without making destructive decisions. I've been through more market cycles than I can count. I've seen people lose fortunes by panicking at the wrong time or getting greedy at the wrong time. I've also seen people build enormous wealth by simply staying invested, staying disciplined, and letting time work in their favor. The difference wasn't intelligence or luck. It was temperament and patience. If you can develop that temperament, if you can train yourself to stay calm when everyone else is losing their heads, you'll be fine. Your money will be protected not by moving it around or trying to outsmart the market, but by having a sound strategy and sticking to it. That's the real secret. That's what separates the people who build lasting wealth from the people who end up with nothing despite having good incomes and good intentions. So what should you do right now? Review your portfolio. Make sure it's appropriate for your age and your needs. Make sure you're not taking more risk than you can handle emotionally. Make sure you have cash set aside for emergencies and near-term expenses. Make sure you're not carrying high interest debt. And then once you've got those basics right, do nothing. Stay invested, stay disciplined, ignore the noise, let time and compounding work for you. That's not exciting advice. It's not going to make for a dramatic story, but it's what works. It's what's worked for me, and it's what I've seen work for countless other people over many decades. Protecting your money isn't about making bold moves or finding secret strategies. It's about avoiding mistakes, staying the course, and letting the fundamental strength of good businesses and sensible investments work in your favor over time. The biggest threat to your wealth isn't out there in the market. It's in the mirror. It's your own tendency to react emotionally, to do something when you should do nothing, to abandon your plan when things get uncomfortable. If you can master that, if you can protect yourself from yourself, your money will take care of itself.